Hello, and welcome to Trading Without Fear. Hello, in this episode, we're going to be talking about systematic trading, what it is, and how it works. Now, keep an eye out for part 2 of this episode, where I go over how to create your own systematic trading system using your data. Now, what I've seen is a lot of traders are coming out saying that the way they become profitable was through a systematic trading approach.
On the short side than I was on the long side. Again, if that makes sense. It makes perfect sense in my head.
So these days, how would you describe yourself as a trader compared to when the market was different a couple years ago? Because I know you go long these days. I
do. So I'm a very systematic, pattern-oriented trader, right? And I think a lot of my success comes from networking with these great traders. You know, I found traders that I resonated with, found traders that traded the same stuff as me, except better, and I networked with them. So, you know, Brittany was the first person I really kind of approached. I met him at one of, Tim Sykes' Inner Circle events. And, he was just like, he's so pattern oriented, so criteria based. It's astounding, like what he will and will not touch. I mean, I think all of us like know at times, like, hey, don't touch that stock, don't touch that stock. Okay, it's perfect, I'll touch that stock. But was it perfect, or did you just give in to, FOMO or greed or whatever it is? And Grittani never gave into that. Like he was so objective about what he traded based off his statistics, and that's why he was so objective, right? So that kind of molded me as a trader. Like I really only wanted to trade the stuff that was objectively statistically backed, pattern oriented trading. Like right now you see the whole market coming down, and I see so many of my friends that are traders trying to buy the dips on these bigger chip stocks, right? Whether it's Disney or whatever.
So to better get an understanding of systematic trading, let's first look at the 3 developmental stages as a trader. Number 1 is systematic trading. Oftentimes people will start in the number 2, which is discretionary or even subjective mode as trading. And the third mode is intuitive mode. Oftentimes newer traders will falsely think they're in intuitive mode of trading, but this is like playing a game of cards without looking at your hands and only playing the players. Discretionary or subjective mode of trading is one of the most common modes of trading that newer traders will start their trading journey in. Oftentimes they'll even struggle with this mode for years. In the subjective mode of trading, you are the one who is in control. You make all the decisions, good or bad. One of the biggest reasons why I believe most traders struggle with this mode of trading is because in the subjective mode, you can change your plan for any reason at any time, leaving more room for emotional-based decisions. These emotional-based decisions are based on the 4 trading beliefs. The 4 trading beliefs are as followed. Number 1, being wrong. Number 2, about losing money. Number 3, about missing out. And number 4, beliefs about leaving money on the table. In the subjective mode of trading, you may be rewarded when making decisions that contradict your trade plan or your core rules. Making consistent income and growing your account becomes frustrating and confusing for some in this mode of trading. In a subjective mode, if you don't execute your stop when the stock reaches your risk and you turn a loss into a larger than expected loss, you may start to find reasons or justify why you're holding on to the trade. The stock begins to turn in your favor and you take a profit. This tricks you into thinking that you can predict what's going to happen next in the market. In the subjective mode of trading, you can do what you want when you want. This leaves room to justify holding on to losing trades. You can buy before the pattern forms, or simply jump into a trade because you think you know what's going to happen and you don't want to miss out. In the subjective mode of trading, without developing the foundation on core trading principles, this is dangerous to your account and your mental health. Now let's look at some skills that you need to experience winning trade. Do you need to have an edge or wait for a pattern to form in the market? Well, no, you can simply just buy because you heard about it on some chat room, or you had a feeling about it, or you saw it going up and you thought it was going to go up even more. Do you have to have a plan of how to execute that trade? Well, no, you can just kind of wing it. When the stock is going up, you'll take profits when you feel like it, or if the stock goes down, you'll decide whether or not you want to cut the trade, or you may hold on to it and give it more time. Do you need to have the discipline to execute the plan without error? Well, no, because you can decide when you want to what's going to happen, and you can form your plan as the trade is forming. Do you need to have a good reason to enter the trade? No, you can just simply jump into the trade for any reason you want. And you can also simply justify the reason to hold on to that trade until you justify the reasons no longer to hold on to that trade. The only skill one needs in order to experience a winning trade is the ability to click on a button of the mouse or on your phone or tablet. There is absolutely no skill necessary in experiencing a winning trade. Now, in contrast, what characteristics distinguish the consistently profitable professional traders from the typical trader? Professional traders plan their trades. They're able to execute their plans without errors. They can even move in and out of a trade without any emotional attachment to the outcome.
Yeah, you can go to the casino and put 100 grand on red and blow it out of the park in just, one lucky roll. I think you get better odds. I think you get better payouts in the market. I think it pays better to gamble in the market, but that's not who I want to be. I want to be the guy that has a systemized process and be a pattern day trader, not someone that's under 25K, but trade patterns as a day trader, right? Just because I feel something can go up or if I feel something can go down, because I think something can go up or go down, it's usually wrong because what do I know? One of the most helpful things to me is admitting that I know nothing. That everyone out there is making you believe in fairy tales and unicorns, MACD, RSI, moving averages, whatever it is. Like, I'm sure they all have Fibonacci sequences. I'm sure they all have some kind of merit. But in reality, what do I have on a chart? I have support, resistance, and VWAP. Like, I don't need all the clutter in my mind because I know at the end of the day, it's just my opinion, and my opinion is probably wrong. But if I stick to something that's been statistically proven and just stay in that lane.
If consistency is your goal and you want to generate an income stream that you can rely on, then you need to be able to identify an edge and have a trading system. You also need to have a plan on how to utilize that edge, including risk parameters, money management and position sizing, and profit objectives. One of the hardest things is developing the mindset and skills to be comfortable with executing your trades flawlessly, so you can utilize your trade plan to its maximum potential. All trading is execution. Using technical analysis does not tell us what will happen next on a trade-by-trade basis. This can be a very real problem. Our minds are wired to associate this moment with past experiences, and our minds are wired to avoid pain. Every trade you put on is more or less a guess. There's no way to know which trade will be profitable versus a non-profitable trade. All you really need is just a pattern or an edge that is back-tested by statistical data. Using your opinion while in a trade may feel good, but you're most likely wrong more than you are right. So with all this being said, what is systematic trading? So let me clarify that before we continue moving on. Systematic trading is also known as mechanical trading. It is a way of predefining trading goals, using risk management, and these rules can make investing and trading decisions in a methodical way. Systematic trading includes both manual modes of trading systems and full or even partial automation using computers. Many people think that systematic trading is all computer-based like in algo trades, and some of them are. Mechanical traders understand that they do not need to know what's going to happen next in the market to make consistent money.
You ever struggle or run into the issue of you're trading your setup, you're doing really well, and then you're only trading your setups because you're being extremely disciplined, but then you hit a string of losers in your setups. Has that ever impacted you for the next couple of trades in your setup or make you be hesitant or make you size less or anything like that? And if so, how were you able to overcome that eventually, or is that something that can still happen?
I feel like that's something that used to happen.
Okay.
And I can't pinpoint that exact emotional gut reaction because it doesn't really happen anymore. Like again, 6 years, right?
Right.
So it's pretty rinse, wash, repeat now. Like I know the setups, I know what I'm doing, I know what to expect and everything. And even if I have 4 losers, I've done this for 6 years, doing the same exact thing. Over 6 years it's played out. 3 weeks of ugly is not gonna dictate the next 6 years.
Right.
If you're any kind of wise businessman, you don't treat your business based off 1 week, 1 month, or even maybe 1 year, but you really don't even base it off 1 year. You base it off 5, 10 years of performance. And it could be a year. You could base your performance off 1 year, but the bigger picture you make it, the more you get stressed out about the in the moments. So what you I get so what you take a 15K drawdown, right?
Yes.
In the next 6 months, I can make 15K in a day, on any good trade.
Mechanical traders understand that your edge gives you a winning percentage over a series of trades and not on a trade-by-trade basis. Like gambling, there is a random distribution between wins and losses. Mechanical traders understand this. Some of the best traders are those who have a gambling mindset.
Stop doing what I was doing because every day I'd come in the Sykes chat and I'd see Grittani doing God's work with these stocks, doing the same thing that I was doing, but just doing it way better with way more size and never strayed. He never strayed from the process, right?
Yes.
That's what's so impressive about him. He's so systematic, right?
Yes.
Because he understands gambling to its fullest. He's a gambler at heart. He loves fantasy football. I think he tried to be a professional gambler at one point.
Yeah.
he knows gambling. He understands how to put the odds in his favor and like why they have to be in your favor, right? And like any kind of deviation destroys everything.
Having an edge in the market is like a professional gambler understand the odds of a winning hand, and the likelihood of them getting that hand based on cards played. The edge in trading is a setup or pattern that places the odds of winning in your favor, as long as you're able to execute the trades without errors. Errors like fear or hesitation, greed and wanting more than what the pattern or setup is able to offer. As a mechanical trader, you only focus on what you know, and that is data. You don't need to know anything else. Mechanical trading tells you what works and what doesn't. It shows you just how wide the gap is between your mental process and what you're capable of taking from the market. Common mistakes of the typical trader or even a newer trader makes is wanting to trade everything, meaning they want to trade every pattern and setup they've learned. The typical trader or newer trader often thinks they can predict the market. They may use words like, I thought the stock had found support and begin to spike. The typical trader or newer trader also is so reluctant in reducing their set of criteria, they trade to one or two setups or patterns in fear they may miss out on the next big runner. Here's something that will boggle the mind of a typical trader or even a newer trader. If you were to draw a circle, and that circle, let's say, would represent all the vast knowledge of both past and present of how to make consistent income from the markets. The consistently profitable professional traders know only about this much. See that small little yellow dot? And that is enough to make consistent income. The rest is invisible to them. The more pattern setups and trading systems and indicators you trade, the more random your results will be. No matter the pattern or setup that presents itself in the market, it could look and feel like the same and have the same news as a past ticker, and it was a huge runner before or a big loser. The typical trader does not understand that even if the same pattern is present in the market, it is independent from any other trade. Every moment in the market is completely unique. When you understand that every moment in the market is unique, and you truly believe that, you'll no longer believe that you need to know what's going to happen next in the market in order to make consistent money. Looking into this state of mind, there is a relative degree of positiveness and negativeness that is rolling through our brains and body at any moment. The nature of a consistency is a function of our state of mind. What trading mechanically does is keep your trading objectively, meaning you are not influenced by personal feelings or opinions while in a trade. Trading objectively is thinking in a probabilistic mindset. Thinking in probabilities means that you believe and act on anything can happen. Every moment in the market is completely unique. You don't need to know what's going to happen next in order to make consistent money. And there is a random distribution between wins and losses and any set of variables that define your pattern or edge. Here are some of the core rules for mechanical trading. Number 1, your entry and exit signals have to be precise, meaning there can be no subjective decision making whatsoever. Either your pattern is present in the market or it is not. Number 2, trade in sample sets of 20 to 25 trades. You'll be doing this instead of taking the next trade. Every time your edge or pattern presents itself in the market, you'll have an obligation to take the next 20 to 25 trades. By taking the next 20 to 25 trades, this is convincing you that anything can happen. Every moment in the market is unique. You don't need to know what's going to happen next in order to make money, and there's a random distribution between wins and losses. Downsize, downsize, downsize. What you want to know if the trading errors you're experiencing is you or an edge that just plainly isn't working. You want to downsize to a level where the size of the position is virtually meaningless. This could very well mean that you may only be able to trade one share or have a limited dollar amount, such as a $200 position, for example. For proper money management, watch my video, Should You Treat Trading Like a Business or a College? Trading Business Plan. I'll put the link in the description below. I encourage you to do this exercise for 90 days. The goal is to be able to do it without any trading errors. If you start the 90-day challenge and review your trading, and you're still finding trading errors, you'll restart the challenge again. You will do it until you have no longer any conflicting or completing thoughts or actions. When you have accomplished this, and it can be very hard for some, you can truly trade without fear. During a sample set of trades, you cannot change any set of variables. After the set has been completed, you will analyze your results, and only after the set is complete are you able to change any variables like profit targets, risk parameters, and for the next set of trades. When trading using sample sets, what you're doing is having a sample set of trades that is large enough to adequately test your edge and small enough to know if the edge is working or not, or maybe it's not working the way that you thought. And you don't even have to lose large amounts of money before you find out. Remember, during a sample set, you cannot make any changes whatsoever. Only at the end of a set can you identify ways that you can increase your edge, things like lowering or highering your profit goals, or increasing or lowering your risk to maximize your edge in the market. During a sample set, you will only include one pattern per sample. Example, if you're trading a gap and crap reversal, a morning panic, and a third-day surge pattern, you'll have to create a sample set per pattern. The next step is to use the data to scale out of the trade as the market makes money available to you. I'll go over this a little bit more in detail in part 2 of this video. So many new traders are still reluctant to reduce their trading size or even dollar amount per trade. I'll often ask them, what is their main focus? Is it to make money or is it to learn consistency in trading? They will say it's to be consistent in trading and to make the money. What they don't understand is that consistent income from trading takes baby steps. To learn how professional traders take small steps to become consistent, watch the video in Trading Baby Steps to Overcoming FOMO and Fixing Bad Trading Habits for Successful Trading. I'll put the link down below. If you think about it, if you can't complete a sample set with a $50 position or a $100 position or even a $200 position flawlessly, then why do you think you can do it with a $1,000 position or even a $10,000 position? Realistically, what difference does the position size make? If you have 13 shares or even 100,000 shares, it doesn't make much of a difference if you're unable to follow this core set of rules without any errors. One thing that I've learned, and something that you may end up learning yourself, is that the trading errors will be present no matter what size you put on. You'll need to divide your daily capital so that you'll have the ability to take every opportunity that may be available to you in the market that is predefined as your edge for that day. During a sample set, keep track of your risk. Some traders use a percent or even a dollar amount, and that's up to you. You could use your risk based on the total dollar amount per day. Like if you want to only risk $50 per trade, then you'll need to find out how many shares you'll need in order to maintain that risk. One of the hardest things that you'll face, and a lot of people have the same problem, is following the system after 3 or 4 consecutive losing trades in a row.
Not the idea, but did you ever struggle or run into the issue of you're trading your setup, you're doing really well, and then you're only trading your setups because you're being extremely disciplined, but then you hit a string of losers in your setups? Has that ever impacted you for the next couple of trades in your setup or make you be hesitant or make you size less or anything like that? And if so, how were you able to overcome that eventually, or is that something that could still happen?
I feel like that's something that used to happen.
Okay.
And I can't pinpoint that exact like emotional gut reaction because it doesn't really happen anymore. Like
Mechanical trading systems is strictly rule-based. This is backed by data and statistics. Many mechanical trading systems do not rely on outside information such as news or fundamentals, or even trader speculations. Even though many of you may have been taught that news matters, mechanical trading systems do not rely on that being part of the trading decisions. A mechanical trader does not place a trade based on what they think will happen next. They have the abilities to be like a sniper and be patient and disciplined to wait for their edge to be present in the market, and for better or for worse, they place the trade when it is. One of the best benefits of mechanical trading is that you are not making any of the trading decisions. You are buying or selling based on proven data and statistics. Because mechanical trading is driven by data, it removes all of the emotional side from your trading. Keep in mind that there is no room for on-the-fly decisions when trading mechanically. Either the trade works or it does not. Either the trade reaches your predetermined profit targets or you get stopped out for a small loss. So that's it for this video. Hope you enjoyed it. If you haven't already subscribed to the channel, please subscribe. Give me a big thumbs up if you like this content, and share this link with any of your fellow traders out there. Make sure to stick around for part 2 for this video, where I go over some data, break it down, and actually show you how to set up a mechanical trading system and kind of tailor towards your style of trading and your own patterns and setups. That's it for today. Bye.